At 34, Tara has big dreams for her future and her daughters. She wants to make their savings work harder. So should she manage her own investments for lower fees and full control? Or pay a little more to have the experts and algorithms do it for her?
I'm now looking to grow a certain amount of money for my retirement and also be able to have enough money to send my daughter to an overseas university education.
Two goals, retirement and her child's education. Both need long-term planning and consistent investing.
On a broad level, I think there's two ways to think about it. One is using a very DIY approach, where you're adopting global diversified portfolios of equity and bonds. Typically, especially for younger investors, you can do it about 80% in equities and 20% in bonds. The other option is to use managed portfolios. So these are kind of baskets of stocks and ETFs as well, selected by experts. They are able to move and adjust the allocations based on macroeconomic climate, as well as your risk levels as it changes over time. Setting up a recurring investment each month, it helps help you maintain a bit of discipline in terms of being very consistent in investing. It's very challenging to time the market. It doesn't really work for the vast majority of investors. So just having a monthly plan and just setting aside whatever you have left after spending into and dollar cost averaging into these portfolios would be great.
And that's where Tara needs to make a choice. Do-it-yourself investing or managed portfolios. DIY investing gives Tara control, but also the homework that comes with it. A managed portfolio is less hassle, but there's a small cost for convenience.
Ultimately, it's a trade-off between convenience and a little bit of fees. So typically, if you DIY, the only fees you're paying are the small expense ratios of the ETFs, which tend to be between 0.02% to 0.2%, so quite negligible. The downside is you have to, might have to balance it over time. If you have a big spending commitment that you need to meet, or for example, your life situation changes, your risk levels and risk appetite change, you'll need to rebalance it yourself. Then compare that to a managed portfolio, there are fees typically between 0.2% to 0.8%, depending on how much you're saving. But there, a lot of the rebalancing happens automatically. You can always just change your risk levels, and then the algorithm actually does mix up the equity bond split as well as the components of the portfolio. The other advantage is that it's also a little bit more complex because it's selected by experts. So it tends to be made up of more ETFs, up to 15 ETFs and about 5 bonds per managed portfolio. So this provides a little bit more diversification that maybe the DIY approach would find it difficult to replicate.
Between work and motherhood, Tara is happy to trade a bit of control for convenience, so she's choosing the managed route. But how much of a difference could her decision make to her returns?
Ultimately, the returns, there are different types of managed portfolios. Typically, the ones that are a bit more passively managed tend to track the market quite closely. So managed portfolios, we can reach around 8% returns, while if you DIY in a broad-based global equity, again, bond split, it might reach around 6 to 7%. So again, this is really dependent on which managed portfolio you're looking at, as well as which ETFs you purchase as well. But typically, the difference, I'd say, is not that huge. And after the management fees, it's also, I'd say, it really close in the ballpark to each other for most cases. I think that really the key here to emphasize is around the convenience itself. Much more so than getting outsized returns from a managed portfolio.
Tara has $50,000 to start her retirement investment journey.
So with $50,000 initial deposit and a $4,000 monthly contribution, over 20 years, an estimated return from, again, managed portfolios of around 8%, we see that the total balance actually rises to $2.4 million, which is a very comfortable retirement amount.
Tara's numbers are based on her own budget, but the principle works for everyone. Whether you invest hundreds or thousands, the key is consistency. Jeremy also helps Tara plan for the long term by managing her taxes. Even tax savings can work harder if you know where to park them.
So there are two big ways you can do to reduce your taxable income. The first one is putting some of your income into the Supplementary Retirement Scheme, SRS, and the other one is topping up your CPF.
Okay.
For the SRS, you can put up to $15,300 each year as a local into the scheme. You can only withdraw it when you're 63 years old, but there are a lot of tax benefits for doing so. The other thing to note is that SRS funds are also investable, so you shouldn't leave it there earning 0.05%. You can invest it in managed portfolios to earn a good rate of return. On the CPF side, you can voluntarily top up for yourself as well as your loved ones, and that also shields the amount from taxes as well.
And while Tara is planning for retirement, she's also investing for her 14-month-old daughter, turning ang pao money into an early lesson in compounding.
So I've been thinking about like what are the best ways to take that funds and invest somewhere so that she has a sizable amount of money as she grows older because she has a longer horizon, right?
You can potentially consider, putting this again in some form of investment portfolio, either broad-based ETFs or managed portfolios, but again in a separate account under her name or her account, so that when she kind of checks in on it, especially as she grows older, she does see the power of compounding, and then that really starts her off on a great foundation for financial literacy.
Tara has set up a monthly recurring investment into a managed portfolio, and she's also making CPF top-ups and SRS contributions. Tara's takeaway, whether it's DIY or managed, it's not about how much you invest. It's about building a system that keeps you invested.